We've been speaking with top economists to better understand what this economic climate means for companies' bottom lines. Today, I'm speaking with Harvard professor Carmen Reinhart. Hi, Professor. Thanks so much for taking the time to talk with me today.
For having me.
Great. All right, I want to start generally. What's the biggest threat to U.S. economic growth right now?
Uncertainty. And uncertainty covers a lot of ground, right? We have policy uncertainty from all angles, whether it's, tariffs, there's still unresolved issues on the fiscal, there's concerns about President Trump's attacks on the Federal Reserve. So there's a lot of uncertainty about policy. Then there's a lot of geopolitical uncertainty as well. We don't like that either. So I think it's really been off the charts what we have seen so far. Markets and the economy have digested it comparatively well, but uncertainty is really on a different scale than the norm.
So what do you think investors should do to protect their portfolios in this time of political and market uncertainty?
Hedging is always a very good thing. In the era between the global financial crisis and the Fed tightening in response to high inflation, we kind of got accustomed to very low volatility. Interest rates were exceptionally low. People got accustomed to that kind of stability. And I think it's important to recognize that era is finished, that I think dealing with more volatile markets. If you look at the VIX in the equity market, it's not exceptional. But if you look at volatility in fixed income markets, if you look at volatility in currency markets, so investors have to be, I think, prepared to deal with higher volatility on a longer run basis. I would also add that corporate managers, uncertainty is a very big no-no for investment, right?
Yeah.
I mean, if you look at all the literature on what drives investment, and uncertainty, it's its enemy. And so it's not surprising that we are seeing medium, longer term plans and investment. That's part of what we have to cope with, whether you're an investor or a corporate.
Sure, that brings up the next question. So is this uncertainty, is it leading towards a recession? Is the U.S. heading towards a recession?
That's, the question of the day, always. They're tough to predict. I was completely wrong when the Fed started to really tighten rates, given the magnitude of the tightening, that we would see a recession. We showed quite a bit of resilience. Then comes Liberation Day, and the odds of recession jumped, but have been stabilizing again. I think, the U.S. so far has shown quite a bit of resilience. The consumer is still in fairly good shape in terms of its spending. It has helped because people don't know what's going to happen, but they assume that what's going to happen with tariffs is not good. There is a lot of consumption. Apart from tariff shocks, there's the enormity of the immigration shocks as well, because a big stimulus to employment growth was immigration, and we don't necessarily see that translating into an immediate recession, but you have to think that as population growth slows, its impact on medium-term potential output has to be on the downside. So the bottom line is, I think recession risks are higher than average, but they're not like the almost overwhelming odds that we saw, right around Liberation Day.
You yourself worked at the Federal Reserve. What role do you think the Fed should have in helping prevent a recession? And should they be lowering interest rates faster than Chairman Powell has suggested they will this year? I believe it was 2 times this year.
I think should rates be lower? It is difficult to make the case of that at the moment, in my view, because, the uncertainty that we've been speaking about is importantly also an uncertainty about a future inflation. So far, the pass-through of tariffs into higher prices has been very modest, but we're still in early stages. In the long list of issues regarding uncertainty, inflation is high among that list. So that would be in line with what Chairman Powell has been pointing to on data dependence. in the course of policy, the signs that there is this overwhelming weakening in economic activity that are a call for monetary policy stimulus, they're not there. You look at various indicators suggesting what the monetary policy stance is, it's not that tight. Liquidity measures, include the equity market, real interest rates, certainly by historic norms, are not that high. I think that there is no obvious reason of why they should be lower.
So you emigrated from Cuba to the U.S. What role does immigration have on economic growth? You alluded to that earlier. Will that change if the U.S. becomes less welcoming towards immigrants?
This is an issue that is very connected to other types of demographic issues that we are facing.
Sure.
We, the U.S. and advanced economies, more extreme cases being Japan and Italy, are all seeing an aging population, declining birth rates, and with that, potential growth is impacted. In the past, immigration has been a contributor to trend growth. So I am concerned from the perspective of what it does to the U.S. economy. It doesn't go in the right direction, especially given our demographics.
President Trump just signed his budget bill into law. The estimates vary, but it seems it will add at least $3 trillion to the deficit over the next 9 or 10 years. Why should the deficit matter to everyday Americans?
Somebody down the road has to pay it, so there is a kick the can down the road. The problems and the tough decisions are still there. But why do we care? For a long time, we had this very benign, neglectful view that we don't worry about high debt because we had the expectations that not only rates were low for long, they were low forever. I don't think that is the world we're living in. The concern about higher debt servicing costs coupled with very high levels of debt, it is one that not only Americans are worried about, but many others as well. So I am very concerned. This debonair attitude is bringing us closer to dealing with, rude awakenings. Also, there's the issue that higher levels of debt and debt servicing means you're spending a lot on debt servicing, you're not spending on other more productive, more growth enhancing possibilities. So that's different aspects of why one might be concerned.
So we've had an era of potentially deglobalization with President Trump's policies trying to bring manufacturing back to the U.S. Has globalization in general helped or hurt the U.S. worker, and how will the economy change, as we move potentially away from globalization?
Even before the mega shock of Liberation Day, we've been in a trend towards deglobalization for some time now. So it hasn't been the same since the global financial crisis. Then we had Brexit. Then we had the first round of Trump with China. And now we have the current one. So globalization has been significantly off its peak. Has it benefited the U.S.? It certainly has benefited the consumer through a greater breadth of products at cheaper prices. So many winners, but greater trade is supposed to be a win-win. Those that lose, which are those that have lost manufacturing jobs to competition elsewhere, in the theoretical trade models, they're compensated.
Yeah.
But in reality, they're not. I think overall, the greatest benefits of globalization have accrued to big export-led economies. China's been, a big model of export-led, and there are others. So what we've seen is some convergence in living standards, right? But for the U.S., I think, notwithstanding the gains to the consumers, it has seen a big hollowing out of various sectors. Do I think we can bring them back? I have my doubts. We shouldn't be overly confident that a lot of the manufacturing that left will ever return. More globalization, more global cooperation is certainly preferred for everyone than variations of a Cold War and a fragmented system. So the economic globalization also had accompanying dividends on the geopolitical front as well that we shouldn't underestimate.
Is there anything else you wanted to touch on?
We've talked about debt concerns. We talked about higher debt servicing costs. We talked about uncertainty and volatility. Now, raise that to a very high power, and you've got what's going on in some of the very low-income countries. This is also an area that doesn't get much headlines, but that the unfolding debt crisis in many of these countries, I think, is something to watch, because as long as it remains in the low-income countries, it is not systemic. It doesn't have consequences for international capital markets. But let's not forget that a major shock in 1982 that changed the course of monetary policy for Paul Volcker was Mexico's default in August of 82. If this were to amplify to some emerging markets that have a bigger footprint, we shouldn't take for granted that that's an additional source of risk that doesn't get that much discussion.